pullback, or reversal. The trap that makes 90% of traders burn their accounts. Ciphers trading welcomes you and everyone. Pullback or reversal can be one of the vital questions for any trader who is closely following the chart. It is so simple that it seems that you only need to learn through a few videos or read a few ebooks to understand. But in reality, because of that apparent simplicity, thousands of traders have lost their entire accounts when the market does not do what they think. Their mistake lies not in the method, but in the way they perceive the transmission. When the market takes a break to continue or has actually ended a trend, imagine you are in the middle of a clear uptrend. The price has run for a long time, the volume has increased steadily, everything seems favorable. Then suddenly, a strong red candle appears. Then there is a bounce to the support zone. You wonder, is this just a simple pullback, or is the market really digging in the direction? Will you hold the position, or will you close it all and enter against the trend? You are not sure, and that uncertainty is a fertile ground for emotions to invade. You start to doubt. You look back at the signal. You try to find a reason to hold the position. Or worse, you open more positions to absorb the loss. This scenario has been repeated by 90% of traders out there, not because they do not know, but because they do not understand that the market has no obligation to warn when it turns from a pullback to a reversal. And no indicator can guarantee that. What they lack is the ability to read the money behind the movement. It is the understanding of the psychological nature of each wave, each jerk, each breath of the market. Sharks do not enter orders like us. They do not need to wait for signals from indicators. They create signals. They need liquidity, and the easiest way to gather liquidity is to create areas of uncertainty, areas where traders have to ask themselves, is this a pullback or a reversal? When traders can't answer that question, they act on emotion. And it's that emotion where the sharks make their real move. If you look at a chart without knowing what stage of the money cycle you are gambling. If you cannot differentiate between a real pullback and a structural trend, you are trading on faith and luck. Step back. Look closely at a chart. There will be periods of strong price increases and then a sudden drop. Many people call this a trend, but then the price continues to increase more strongly, even breaking that top. That is a pullback. And there are also times when the price drops slightly, looking like a benign pullback. But then it quietly accumulates volume, and after a few candles, a big downtrend begins. That is a trend. So what makes two similar-looking phenomena lead to completely different results? It is the position. It is the context, it is the volume, it is the money structure. A pullback is a purposeful rest. It is when the market needs to take a breather to continue the main trend. Usually occurs after a strong increase or decrease with gradually weakening volume and does not break the main support or resistance levels. Pullbacks usually occur within the safe margin of the market structure. They do not break the long-term trend line. They also do not appear during the time of shocking news. On the contrary, the direction is when large money flows out of the market or when a new, stronger force takes over. The direction often comes with a sudden volume spike, not at the beginning but in the middle of the pullback. It can break the structure, sweep through the support or resistance zone, making traders think it is just a fake breakout. But in fact, it is the beginning of a new order. What is the problem? When everything is still going on, you cannot be sure, and it is that uncertainty that is where the sharks lie. They know that retail traders learn one thing after a few losses: do not catch the top, do not catch the bottom, only trade on pullbacks. And so they create pullbacks to collect all the traders' buy orders at the bottom before pushing the price down hard, or create a deep drop, then push the price back up, past the top, making people believe the trend is still there, and then really crash. You think you are trading pullbacks, but you're stuck in a massive distribution scheme. You think you caught the retracement before the trend continues, but in reality, that's the last point where the whales need you to enter so they can dump. If you're still looking at the market with your naked eye, you'll never be able to tell the difference between a pullback and a reversal, because on the chart, they look the same. But at the money level, they're completely different. So you need a system to decipher that. And that system doesn't start with indicators. It starts with the question, who's acting, who's withdrawing, who's waiting? A real pullback usually comes with signs of volume exhaustion, small candles, no important structure break. It happens in the trust zone. And after that pullback, the price recovers strongly. Predictably, the volume increases accordingly. As for the million reversal, it usually comes after a final rally, the last increase in the trend. This part is very attractive, strong increase, decisive, causing FOMO. But the volume started to diverge and then the breakdown. A long bearish candle, closed low, followed by a few candles with a slight recovery, thought to be a pullback, but then fell again. At this point, the structure has broken. What do you see here? A million reversal always starts as a pullback, and a pullback always ends as a million reversal, if you don't know the setup point. That's where the trap lies. Traders don't accept it. They expect a pullback, but refuse to cut when the structure has changed. They believe in the signal, but not in the truth. And the truth is, the market doesn't give any warning, it only gives signals. How you react is what determines whether your account lives or dies. The question is no longer how to distinguish a pullback or a million reversal, but how to survive, whichever it is. Before entering any order, you must answer the question, what if it's wrong? If it's not a pullback, but a million reversal, how much do you lose? If it's not a real million reversal, but just a swing, how do you handle it? Only when you have scenarios for both cases, you are trading, not extreme. A simple but effective strategy is to use market structure combined with volume analysis. Let's say you see an uptrend. The price starts to correct. You don't rush to enter. You watch to see where the price corrects. Fibonacci 61.8, the old support zone or the demand zone created by the previous breakout? You look at the volume. Is it decreasing during the correction? If so, that's a sign of a healthy pullback. You watch the price action. Are there pinwars, zojis, or bullish engulfing candles at the support zone? If so, you start considering entering, but with a clearly defined risk. However, if the volume increases during the correction and strong closing candles appear below the support zone, you should stop, because it is very likely that it is the beginning of a new trend. Many traders die because they believe too much in the support, resistance, and feeble zones without understanding that behind that pattern is the distribution behavior of big players. So, specifically, what do you need to do? First, you need to clearly mark important structure zones on the chart. It can be the old bottom, top, previous sideways zone, or high volume zone. Then, you observe how the price reacts there. Do not enter an order when the price just touches the zone, but wait for specific behavior. Afternoon digging candle, confirmed volume, false breakout is denied. Next, use a larger time frame to get the overall picture. Many traders fall into the trap of digging the afternoon just because they trade on the 5-minute or 15-minute time frame, but do not know that on the 4-hour or the daily, it is just a rally. On the contrary, many people see the price increase sharply on the small time frame, but do not know that on the large time frame, it is a final pump of the sharks before dumping. That is why you need a rule, a simple but extremely effective rule. If the short-term structure breaks, the volume increases, and the price cannot recover quickly, then you should not continue to hold the order in the old direction. Do not try to prove yourself right. Prove that you know how to protect your capital. And the most important thing is psychology. You need to practice acceptance. Accept that the market can go against your expectations. Accept that you will be wrong. And when you are wrong, the only thing to do is cut your losses and wait for a new opportunity. Good traders don't win by guessing right. They win by not dying when they guess wrong. So change your mindset. Don't ask if this is a pullback or a dip. Ask, what will I do if it doesn't go as I think? If you have a clear answer, you will survive. And finally, don't forget that the market is a survival system. Those who cling to beliefs will be eliminated.
Those who are flexible and react based on real signals will survive in the long run. Pullback and dip are just two sides of the same coin. What matters is where you stand, what you are holding, and whether you dare to let go when needed. Look at the market as a global psychological game, where the big players don't need to win, they just need you to lose. And to make you lose, they just need to plant a question in you that has no answer. Is this a pullback or a dip? The market is not programmed to explain its actions to you. It just exists, operates, moves in the way that the big money wants to control. Retail traders are just a grain of sand drifting in the waves. If you keep looking for a definitive answer to every move, you will burn out. And then you will start trading for emotional satisfaction more than to make money. The longevity of a trader is not about the number of correct trades, but the ability to keep a steady.
You are not sure what is happening. That is the moment when the market suddenly digs in without warning. That is the moment when the technical signals lie. That is the moment when you are forced to choose between keeping the faith or letting go to preserve your account. And it is in those moments that you will clearly see who you are. Trading is not a game of precision, but a game of adaptation. The one who adapts the fastest, accepts mistakes the earliest, and acts the most disciplined will survive. And the irony is that pullback or afternoon dig is no longer important. What matters is that you are ready for both. The mindset of a good trader is not based on affirming what will happen, but on reacting when things do not happen as expected. They do not force, they do not fight reality. They quietly exit orders when the market changes direction. And then they patiently wait up for the next opportunity. Let's go back to the principle of how big money flows. When the sharks want to collect goods, they do not buy immediately. They let the market fall. Let the small traders think that this is an afternoon dig so they can sell. And then the sharks collect silently. On the contrary, when they want to sell, they let the price increase beyond the peak, creating a FOMO signal, making people think that this is a simple pullback in an uptrend. But in fact, it is a distribution zone. If you do not see this, you will always trade against the big money flow. Remember, the market has three main phases: accumulation, price push, and distribution. Pullbacks often occur in the price push phase, when the market needs to rest to continue the trend. And the afternoon digging usually starts at the end of the distribution phase, when the market has reached psychological equilibrium. And the sad thing is, these two phases look very similar on the surface. Both have bearish waves, both have technical signals, but inside, the intention of the money flow is completely different. So instead of trying to guess, learn to read. Read the money flow, read the volume, read the price behavior, and above all, read your own psychology. Are you afraid of losing or hoping to win? Are you entering because of technical structure or because you don't want to miss an opportunity? If you are not honest with yourself, you will not be able to distinguish between a pullback and a dip, because at that time, the market only reflects your emotions, not the truth. Practice an important skill that most traders never talk about. Stand still, do nothing, observe, let the market speak for itself, and when everything is clear, you act. Losing traders are those who enter orders all the time. Professional traders are those who know when to stay out. Not trading is also an order. The answer will determine how long your account will last. Remember, every trap has something in common. It is designed to prey on expectations. When you expect too much of something, you will be blind to the opposite signals. Pullbacks and reversals can both become traps if you have no stop loss, and no clear plan. And conversely, there is no real trap if you only act when everything is clear. You cannot avoid all risks, but you can limit them. And in trading, Limiting risks is more important than finding profits. This is the time for you to review your charts. Recent losing trades. Did you lose because the market fooled you or because you fooled yourself? Did you lose because the market reversed suddenly or because you refused to accept that it had reversed? You entered the trade according to the plan. Just let your emotions be released. A real trader is not someone who is always right, but someone who always keeps calm to survive the mistakes. Make the question of pullback or reversal a reflective tool. Every time you are about to enter a trade, stop and ask, can I be wrong? If I am wrong, will I lose everything? If I don't lose everything, how long will it take to recover? If you can answer these three questions calmly, then you are mature enough to survive. And if you are still trading in the crypto and forex markets, don't forget that you are not alone. Join our Signal group in the video description, where you will not only get a trading plan, but also a counter-argument that will help you avoid traps like this one. Subscribe if you find what I share useful, so I can continue to bring you insightful, practical, and most importantly, content that can save your account before it's too late. And share your story in the comments. How have you been trapped in pullbacks or reversals? How much did you lose because you didn't close your trades in time? What did you learn from those crashes? Maybe someone reading your comments will find a common thread and they will avoid the same mistake you made. Let's make this community a place where traders don't have to fight alone. And finally, if you find yourself in a chart where you don't know what you're looking at, aren't sure if the market is resting or about to turn, aren't sure if your order is keeping society or is going to die, just remember this. You don't need to know where the market is going, you just need to know what you're going to do if it doesn't go your way.